Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we want to talk to you about small cap stock and why you should have small cap stock in your portfolio. Recently we've had some new clients come to us, and almost every single one of them, when we started to review their portfolio that they had before they came to us, did not have small cap. They only had large cap in terms of domestic exposure. And we think that is a big mistake. And a lot of these people, as a matter of fact, happen to also have advisors. And so I'm not sure what those advisors were doing, because there is absolutely a role in everybody's portfolio for small cap stock.
There is. In fact, what's interesting is, I think what we've seen is a lot of clients come to us that have what I could call them sort of compressed portfolios. They only have 2-3 asset classes. They'll have large cap, they'll have bonds, and maybe some international. But like you say, we've seen a lot of clients come to us that do not have small cap. And I don't understand, quite honestly.
Right. And so we should probably actually define what small cap is when we talk about small cap,
Yeah.
right? It's just another capitalization. Basically, the market, we tend to divide the market up into 3 different sectors:
Yep.
large caps, mid cap, and small cap. Everybody knows large cap. When you turn on the TV and you look at the S&P 500 or the Dow, you're talking about the top largest companies in the country. And so people tend to gravitate towards those stocks. Or if you invest in an S&P 500 index, you're essentially investing in large cap stocks. But when we're talking about large cap stocks, we're talking about companies that are worth 10 billion or more in terms of their value, the number of shares outstanding times their price. $10 billion worth of shares out there. When we talk about mid cap, we're talking about somewhere in the neighborhood of between 2 billion and 10 billion, and
That's
small
right.
cap are everything underneath that. They might have as little as 300 million up to about 2 billion.
So it's important to consider what happens when a company becomes very large. When a company becomes very, very large, they've probably filled up the market for their product or their service. So it's very hard for them to grow at a higher rate. Whereas a small company, they probably have not even come close in many cases to filling up all the potential demand for their product or their service. So the potential for growth there is probably much higher than for a large company. But on the other hand, the risk is also much greater.
Right. So on one hand, a large company, we recognize, we know where their profit's coming from. Small cap, not as much. There's more of a question of what's going to happen. And so that's why there's more risk, but there's also more opportunity for return. So we have the slide up here. This actually, again, talks about the whole idea of the science behind modern portfolio theory and how we invest our clients' portfolios. And we're going to come back to this all the time whenever we're talking to you about your portfolio, because the science is well documented. There's empirical data that supports the theory, and we've seen it work. We've seen it in real time work over the years. And
many people have back tested this, by the way, over the years as well. So.
Right. So the science, again, talks about having at least more than one asset class. It talks about having 2 asset classes or more. But no matter what you have in terms of asset classes, you want to have asset classes that perform differently. One's going in one direction, the other's going in the other direction, or vice versa. And so by adding these 2 asset classes together, we're getting a smoother return over the long run. We're not reaching the high highs of either of those asset classes, but we're not reaching the low lows of each of those asset classes.
And I do want to mention, there are times, and we've seen it, and we don't want our clients to be fooled by this, where diversification will fail temporarily. We have seen this both in 2008 and 2020. And what happens then is a lot of people and a lot of advisors and pundits leap on that and say, gee, diversification really doesn't work, because it does at times fail when you want it the most. And I will say small cap stocks do become pretty correlated. In other words, their price movements become pretty linked to large cap stocks. when we experience financial panics. But that does not mean that you should not be invested in small cap.
Okay, Steve, so I don't have an argument in front of our clients here, but I still maintain that in 2008, diversification still did work because our bonds, both domestic and
Mhm.
international, did hold up. And so everything didn't go down. And so, again, it's like, what do you have in your portfolio? Have you
Yeah.
picked enough different asset classes that have different patterns of behavior?
And you're right about that. Well, the problem, I guess, is, Laura, and you brought up a very good point, is that the people who said it didn't work didn't have the right types of bonds. They might have had corporate bonds and high yield bonds, expecting them to act as diversifiers when you experience a risk on environment. And corporate bonds and high yield bonds don't act that way.
Right.
They act
So
like
they're
corporate.
highly correlated already.
Yep, yep, you're absolutely right about that.
Yeah. Okay. So we always talk about having this type of strategy is almost like having an all-weather strategy. It'll be successful no matter what actually happens in the marketplace. And it's kind of like this idea where, let's say you owned a booth at a farmer's market and you sold sunglasses. And every day it was sunny and people would come and they'd buy your sunglasses. And you'd have red sunglasses and green sunglasses and big sunglasses and little sunglasses and all kinds of different sunglasses, but they all pretty much were intended to do the same thing, right? Shield your eyes from the sun.
Yep.
But now, all of a sudden, you have a couple of rainy days and you realize nobody's coming to my booth. I'm spending all this money for my booth and I have no revenue coming in. So perhaps I should do something different. What if I get rid of some of my sunglasses and replace it with a different kind of asset, an asset that behaves differently and has a different purpose? And so if I replace it with umbrellas, when it's raining, people will come to my booth and buy umbrellas. When it's sunny, people will come to my booth and buy sunglasses, but I'll always have a sale. And so that's kind of the idea around asset classes, is to find those groups of investments that operate very, very similar in similar environments, and then find other ones that operate differently. And
I want to
that's
mention, and this is an important point, and I think your illustration is fantastic here, Laura. The analogy is that you are giving up some important, I would call inventory space to this other product. So because you probably have limited space, but on the other hand, even though you're giving up some limited space to have this other product, you're smoothing out your cash flow on a daily basis, and that's
and
important.
yeah, absolutely. And so we actually wanted to look at even what happened over the past 20 years between large cap and small cap. And if you were a holder of just the S&P 500, as many of our newer clients had been, you would have seen your portfolio perform like the blue line. Now here we show $100 invested in the beginning of 2000 over a 20-year period at the end of 2020. And what we see is a return of around 6%, I believe that is, a little bit more than 6%. You
Yeah.
would have $384 in your pocket. However, if you had taken the risk and had put all of your $100 on small cap stock, which, notice it's a little bit more volatile, that you can see that line is a little bit more wiggly, but you would have had $718, which is over almost 8.8, I think almost 9% return from the beginning of 2000. So of course, if we had a crystal ball, we would have said, okay, let's put all our money in small cap stock, but we're responsible fiduciary advisors, and we would never tell a client to put all their money on one horse,
Yeah.
especially a volatile horse like that. So there is an alternative.
Yeah.
And
And I want to mention what a couple reasons why we don't like to do that. First of all, small cap is a volatile asset class, and its volatility, which we show here is the wiggliness in the line, is roughly double that of large company stocks as a whole, small company as a whole. Although when you get into small company value, it's maybe only about 50% more risky than large cap, not quite double. The other reason why we like to blend these asset classes together is because there could be long periods of time where one asset class will underperform. And we could see that even with small cap, there have been times when that happens. And so once again, that goes back to the idea of the person selling sunglasses. What happens if you have 5 rainy days in a row, right? You have no revenue for the week.
Mhm. So Steve, you kind of almost gave the punchline. What is the solution? Which is on the next slide.
Yep.
The solution is to take a 50%, $50 and put it in large cap, $50 put in small cap. We actually are much more sophisticated with our ratios. We don't actually do 50-50. We found a better optimum mix. But for argument's sake, for this simple presentation, 50-50 will do, where we show that that mixture would have given you a $536 at the end of the overall 20-year period, which is much better than what you would have had if you were just in large cap stock.
You know, small cap. I think Laura, you wrote in the blog that's going to be posted in a couple of days. The small cap is also pure exposure to our domestic stock, and the reason is because a lot of times these small companies don't have. They're not really multinational companies. They don't have a lot of sales overseas, so you're getting, I would say, more a pure exposure to the United States economy than you will with a large company stock, which does have a lot of sales overseas. So they're also affected by currency more. They're affected by what happens to international economies, that sort of thing as well.
Right, and so when the GDP is forecasted to go up, oftentimes people do expect small cap to perform much more closely with the GDP. And we also see that oftentimes when we're coming out of a contraction, that that small cap will lead the way. And we see that
Right.
actually, we've seen that over the past. And maybe we could go to the following slide, which is the Calallen Table. This table, Calallen has produced this table back since the 70s. They always have a rolling 20-year period. We like it because it really does give you a sense of what's going on here. Each color represents an asset class. So you could see that, for example, the light baby blue color is the small cap equity. You can see small cap was on top in 2010, 2013, 2018, 2020. And large cap is the darker blue. And the way the Callahan table is devised, they put the best performing asset class on the top and the worst performing asset class on the bottom. And so just looking at this, you can see how no asset class is ever on the top for any length of time or on the bottom for any length of time. They're constantly jockeying for position. And what's quite interesting is that you can see as we're coming out of 2008, that small cap is actually leading the way in terms of performance, exactly what we said. And I believe in 2002, we saw pretty much the same thing. If you notice, small cap is above large cap, and then in 2003, small cap was again above large cap. And in fact, in 2020, it was only at the end of the year did small cap start really accelerating.
Last 2 months of the year, November and December, I think.
Okay, so because if we had looked at this Callahan table with just year to date in June, on the top here actually would have been bonds. And then if we looked at it at the end of September, on the top here might have been large cap, but small cap quickly came in and saved the day and is continuing to make its mark. The first quarter of this year, small cap has been our top performing asset class. Steve, what is our percent or something?
One of our holdings is up about, I guess, between 45 to 50% last time I looked for this year. And it's a small, it's an ETF that's oriented towards small cap value, by the way. So you know, this shows also why it's so hard to predict, even when small cap is a winner, how much it might win by. It's very hard to predict what these returns are going to be, and also when it's going to be the winner. It's even harder for small cap than it is for large, and that's hard enough on its own.
Absolutely. So why should you hold small cap? Well, first of all, it rounds out your portfolio. It gives you more diversification in terms of the even just the domestic market. Forget about even getting into international and other diversifiers. So it's non-correlated exposure. It provides you also some of that opportunity to take on that additional risk, which can bring you extra return. There is a whole theory around the small cap premium over large cap that talks about the fact that, especially in certain times of the business cycle, small cap will outperform large cap. And so that's the other reason. And then there's one other thing too. If you are at all interested in using active managers, small cap might make a little bit more sense to use an active manager than
A
large.
little.
Well, there's less eyeballs on the small cap sector. There's less focus on that. And there could be potential opportunities in the small cap space more than in the large cap, which is so efficient.
Yeah, and it's so efficient that I think it was the Wall Street Journal, I think last week said that over the past 20 years, of all of the large cap funds that are still in existence, only 6% beat their benchmark over the last 20 years. So it's a game of chance
Right.
when you're picking active managers, and it might be less so for small cap because, as Laura mentioned, a lot of those companies aren't as researched as well as the large cap companies are.
So, again, as an investor, we think that is a big mistake to ignore small cap. We think it has a place in everybody's portfolio. And as always, if you want to talk a little bit more about your portfolio, how much small cap you have in your portfolio, or what we're doing with your portfolio, we are always available to talk to you. Thank you. Have a great day.